As of right now, Monday, February 2, 2026 at 9:58 a.m. ET, Beyond Meat Inc. is trading live at $0.73 per share, representing a sharp intraday drop of 4.10% since the opening bell. The stock started the morning at $0.76, but quickly faced selling pressure that pushed it down toward its 52-week low. This movement isn't just a random squiggle on a chart, it is a visceral reaction to the growing gap between the lofty expectations of a plant-based future and the cold reality of a shrinking balance sheet. While most investors are watching the price drop and assuming the story is over, the real insight here is found in the volume. We are seeing over 4.4 million shares change hands in the first half hour of trading alone. This tells us that institutional activity is accelerating, but not necessarily in the way retail traders hope. When a stock dips into the sub-$1 territory, it stops being a growth play and starts being a liquidation or restructuring play. The common belief among many who use the Robinhood app or search for investment help online is that Beyond Meat is a classic buy-the-dip candidate because of its brand recognition. You see it in grocery stores, you see it in fast food partnerships, and the natural thought is that eventually it has to bounce back. However, the reality is far more punishing. The market is currently pricing Beyond Meat like a company that is fighting for its very existence. Unlike the momentum we see in Nvidia stock or the steady climb of Apple stock, Beyond Meat is caught in a cycle of high cash burn and declining consumer interest. It is no longer enough to just be the first mover in the plant-based space. Today, the competition is fierce, and the cost of production remains a massive weight on their shoulders. While the company has secured new financing recently to keep the lights on, that debt comes at a high price, and the market knows it. If you look at how people are handling their self-investing strategies lately, there is a clear trend of moving away from speculative plays like BYND and toward more stable assets. Even within the world of online investing, the appetite for risk has shifted. People are looking at things like Schwab Intelligent Portfolios or a diversified individual brokerage account at Fidelity to protect their capital. They are realizing that betting on a turnaround in the plant-based sector requires more than just hope. It requires a fundamental shift in how the business operates. Beyond Meat is currently projecting a positive EBITDA run rate by the end of 2026, but to get there, they have to cut costs so deeply that it might stifle their ability to innovate. It's a classic catch-22. If they don't spend on marketing and R&D, they lose market share. If they do spend, they run out of cash. The recent stock movement is a reflection of this desperation. When you see a 4% drop in the first few minutes of a Monday morning, it often indicates that large-scale holders are rebalancing their portfolios away from underperforming assets. Institutional activity has been leaning toward the exit for several quarters now. We aren't seeing the kind of accumulation you'd expect from value investors. Instead, we see the type of churn associated with penny stocks. This is a far cry from the days when Beyond Meat was the darling of the NASDAQ, trading at hundreds of dollars per share. The tension between the expectation that plant-based meat would replace traditional animal protein and the reality that it remains a niche premium product has finally reached a breaking point. Let's talk about what the company actually does for a moment, because it's easy to forget the business behind the ticker. Beyond Meat produces plant-based substitutes for beef, pork, and poultry. Their business model relies on high-volume manufacturing and widespread distribution through retail and food service channels. In the past, they enjoyed massive success with partners like McDonald's and Yum Brands. However, recent reports show that those partnerships haven't scaled as quickly as investors once dreamed. The cost of their ingredients, primarily pea protein, has been volatile, and unlike Tesla stock, which has managed to lower production costs through massive scale and vertical integration, Beyond Meat is still struggling to achieve those same efficiencies. They are essentially a manufacturing company with the margins of a commodity player, but without the benefit of a cheap, limitless supply chain. In the world of online investing, you often hear about the death cross or other technical indicators, but with BYND, the most important metric is the cash-to-debt ratio. They are operating in a space where they have to convince consumers to pay a premium for a product during a time of high inflation. When people look for investment help on investing sites, they are often told to look for moats. Beyond Meat's moat was their brand, but that brand has been diluted by private label competitors and other well-funded startups. Even on platforms like SoFi Invest or through a Fidelity brokerage account, the data is showing that investors are rotating into sectors with clearer paths to profitability. The plant-based sector is currently in a show-me phase, and so far, Beyond Meat hasn't shown enough. Comment below how many shares of Beyond Meat you currently hold, or if you've completely moved on to other sectors like AI or energy. I want to know if you think the plant-based trend is a long-term winner or just a temporary fad that peaked a few years ago. Your perspective on this is vital because it helps us understand the retail sentiment that drives so much of the price action we see on the Robinhood app. Looking toward the future outlook, there are a few catalysts that could potentially save the stock, but they are high risk. One is a total pivot toward a more health-focused product line. They've recently tried to market the cleaner aspects of their ingredients to combat the highly processed narrative that has hurt sales. Another possibility is a buyout. A larger food conglomerate might see value in the brand and the intellectual property, but they would likely wait for the price to drop even further before making a move. For those of us using interactive brokers or managing our own SoFi active investing accounts, the risk-to-reward ratio here is incredibly lopsided. The potential for a 100% gain exists if they pull off a miracle, but the potential for a total loss is also very real. Compare this to something like Nvidia stock or Apple stock. Those companies have consistent cash flow and a product that the world is desperate for. Beyond Meat has to fight for every inch of shelf space and every customer. When you're self-investing, you have to ask yourself if you're buying a business or just a ticker symbol. Right now, the market is telling us that the business model is under heavy fire. Macroeconomic pressures like rising labor costs and fluctuating ingredient prices are not helping. If you're looking at your Fidelity mobile app and seeing BYND in the red, it's a reminder that the expectation of a green future has to be grounded in the reality of profitable operations. The institutional sentiment is worth noting. Large funds and wealth management firms, like those managed through Fidelity Wealth Management, have been steadily decreasing their exposure to the plant-based sector. They are looking for quality over story. In 2020, the story was enough. In 2026, the market demands earnings. Beyond Meat's upcoming earnings report on February 25th is going to be a make-or-break moment. If they miss their targets again, or if they lower their guidance for the rest of the year, we could see the stock fall even further into the abyss. On the other hand, a surprise beat or a significant narrowing of losses could trigger a short squeeze. Because so many people are betting against this stock, any positive news can cause a rapid, though often temporary, spike in price. This is where the psychology of trading comes into play. Many retail traders on the Robinhood trading platform see a low price and think it's cheap, but a stock is only cheap if it's worth more than you're paying for it. If a company is burning cash and losing customers, a $0.73 share price might actually be expensive. This is why using professional tools like the Interactive Brokers platform or researching through Fidelity ETFs and Fidelity mutual funds is so important. You need to see the broader context of the industry. The packaged food sector as a whole is struggling with margins, but Beyond Meat is at the extreme end of that struggle. The reality of the situation is that Beyond Meat is a pioneer that might have arrived too early, or perhaps with a product that was too expensive for the mass market. They've spent years trying to reach price parity with animal meat, but they aren't there yet. Meanwhile, consumers are becoming more price sensitive. When you're browsing investing sites or looking for investment help, you'll see that the companies winning right now are the ones with pricing power. Beyond Meat has very little pricing power. If they raise prices, people just buy real beef or a cheaper plant-based alternative. If they lower prices, they lose money on every burger sold. It is a brutal position to be in. To wrap this up, the central insight today is that Beyond Meat is no longer trading on the potential of the plant-based industry, but on the immediate solvency of its own corporate structure. The 4.10% drop we're seeing right now at $0.73 is a symptom of a market that has lost its patience. The expectation of a global shift in diet has been replaced